Welcome to the episode of BW CFO World Number and Narratives. Raising money is one thing, raising it right at the right cost through the right instrument at the right time is entirely another challenge, especially in a sector which is capital intensive and policy sensitive as EV manufacturing. Today's conversation is around financing the EV transition, capital strategy in a policy driven volatile market, unpacking exactly that today. Joining us, Mr. Deepak Rastogi, CFO at Ola Electric. Mr. Rastogi has over 2 decades of experience in finance leadership across EV, real estate, fertilizers, auto components, and industrial manufacturing, including senior roles at Deepak Fertilizers and Petrochemicals, Tata Motor Corp, and Timken. Welcome, Mr. Rastogi. How are you?
Very good, Divya. Thank you so much
Well,
for your generous introduction.
Well, before we move on to the serious conversation, I would like to start with a softer note. So, Mr. Rastogi, if finance hadn't found you, what career do you think you would have pursued instead?
I wanted to be a chemical engineer, and if I would not have been a chartered accountant, I would have gone into an engineering stream then.
Okay. So, Mr. Rastogi, now we move to the serious discussion. So, as we know that earlier, India's EV policy used to be focused on subsidies for buyers through this scheme like FAME. Now it's shifting towards incentives for manufacturers who localize production. So, as a CFO, how do you rethink where you put your capital when support moves from the demand side to the supplier side?
So I actually, see this as an evaluation to actually creating a supply chain, local supply chain within India, right? That's this policy is driven by that. So, and it is definitely not a withdrawal of a demand, support. Because we do not have the supply chain, within India. Most of that is localized in China and ASEAN world, and hence there has been a lot of government initiatives to ensure that we bring back those supplies, here to India and localize it. So the decision making purely from a subsidy perspective will be like what are the lines, vertical integrations which the companies can do it, what kind of localization can do it, how does it actually helps in the overall unit economics, are they sustainable, and then accordingly developing those supply chains within India. Policy, subsidy or FAME incentives are not the parameters to look at, right? In the sense purely from a profitability lens, most of the companies actually look for that will I be still be profitably within India, means domestically as well as globally, if I without even a subsidy, right? Most of the companies have started thinking towards that, and if this actually helps in that kind of a journey, obviously the company should take those things. But just purely there is a subsidy which is actually there for a particular period of time, that should not determine the decision making where the company should invest and where they should not invest, right? So they have to have a holistic view. If without a subsidy the companies can actually be making very profitable business, obviously they should go for it. It should be seen as more of an icing on the cake as opposed to just the cake itself.
Very well explained, sir. So, sir, that the importing batteries and critical minerals put a lot of cost pressure in EV manufacturing. What treasury or hedging strategies do you think underused in this sector to manage that risk?
So there are two instruments, one is the hedging of the currency and the other is the hedging of the commodity. We have to see these two from two different lenses. They are not the same. As far as the hedge is concerned, for a currency perspective, obviously the companies should look for net hedging, which means like what is my actually currency exposure, what are the imports if there are any, there could be some exports out of it, and based on which the companies should devise their obviously hedge obviously I would say a policy around that. The second thing is For a long-term hedge, obviously, then you have to really have a hedge, not actually an option or a collar. For the short term, wherein the supply chains are very well set, we know the product is coming in. Definitely, you can actually go for, obviously, a pure this thing. But as far as the long terms are concerned, there has to be like a option, which gives more flexibility. You can actually make those changes and all. In fact, there are also interest rate hedge which are in the marketplace. So apart from the currency, the interest rate hedge can also be used as a tool to make sure that we are able to maintain the profitability. As far as the commodity is concerned, commodities again, it's very similar that especially for the battery manufacturing, for lithium, cobalt, and any other commodity, they are available. And if it's depending upon what kind of benefits and cost which is associated with the hedge. But otherwise, the companies can also use a natural, by way of a natural hedge, which means like, you have a agreement with the supplier, which is much more commodity driven, because, for every commodity, there are commodity benchmarks, and every quarter or every month there is a reset. So, you pass it on to the supplier or take it from the supplier based on what that agreement is, if that the cost becomes super prohibitive. But those are more, I would say, short term, and they are bound by the agreement and things like that. Look, the critical part for a CFO to understand is that we should be able to create a sustainable margin of the business and minimize the volatility. We should not be actually into like some kind of gambling, that we should not be really using that tool for profit maximization a lot. It should make sure that the policy should actually cover the risk which are associated with it, and there are sustainable margins which it's predictable what is going to come in future. I think that should be the way the company should use it for their strengths.
Sustainability linked loans are becoming more popular in Indian capital right now. So, sir, do you think that the lower cost of borrowing they offer is actually worth the extra compliance and reporting work that comes with them, especially for a manufacturing heavy business?
So, it depends upon, if there are certain timelines and, there are predictable projects which are actually available, then the company should go for it, because obviously it comes with a lot of compliances. There are risk of not meeting those compliances or any obligations which comes so if it is for a single project, or a few projects for smaller investments, I do not think so that green bond would be the way to go. But when the companies can assess their own situation to see, do they have projects which actually fall under the eligibility of these criteria to be able to get those. So if there is a sustainable requirement of a green bond, means like the green money, from that perspective, yes, they should go about it. But obviously in that case, the compliance cost will be embedded as the part of what you are going through the journey. But overall, just cost of capital should not be seen in isolation versus most of the companies, they just look from that lens, right? Whether my cost of capital is coming down, and they do not see the risk which is associated with not actually complying with the requirements when anybody takes the green bond. So that the companies should have to be cognizant of it. CFOs should be able to see these through, and only when there is a certainty, then definitely they should actually go for these green bonds or sustainable linked loans.
How do you personally decide between raising equity, taking on a debt, or going with a mix of both when sentiment is this unpredictable?
So, I will give you a short and I will also give you a long answer. Generally, equity should actually fund technology product development, market creation and expansion. Generally that's the way it is, wherein you do not have the certainty, or there are no predictable cash flows, to start with. As far as the debt is concerned, it is obviously the cheapest mode of borrowing, but unless or until there is a predictability of the cash flows, we should not actually, the company should not look for those, avenues, raising debt. As far as the hybrid is concerned, they are more of a bridge financing. When you are in an inflection mode, you need a huge amount of capital so that at one point in time it comes through, and then just take it off and then decide if it becomes predictable, go to the debt. If it is still unpredictable, then you can have a combination of a debt and an equity, depending upon obviously the way the overall forecast looks like. But I would then assess dilution, interest coverage, covenants, which is coming in, what is the headroom, maturity, concentration, and liquidity. Eventually, it all boils down to what kind of liquidity the company has it, what kind of obligations each instrument brings in, and what kind of responsibilities the companies can shoulder, and based on the projections of the project or the company, it can be mixed and matched accordingly. And every time you would ask this question, the answer could be different, because the course and the landscape of the business would have changed since then. And the last thing is that, look, the company should not look for the cheapest mode of capital. They should actually look for sustainability, and they should also look for in a volatility, whether they can actually go through that hook in terms of liquidity, even though it could come as a at slightly at an expensive price. But liquidity still remains the critical part after meeting all the obligations which the company has.
So, sir, as we see it from the investor side, earlier investor used to see EV as a clean manufacturing company mainly for growth. Now they want to see the real unit economics and the clear path to profitability. So, how has the shift changed the story you tell investors?
The basic underlying thing is that growth is not just this thing. If it has to be a growth, it has to be profitable. If we are going for expansion as a company, then whether there are predictable cash flows, whether overall the company will start generating positive cash flows from operations. The third question which everybody would come back is that whether with the expansion mode, whether the unit economics of the product is actually improving. So so they start looking from those lenses now, as opposed to just only sticking around. And everybody thinks, whatever we do today, whether the company is on a path of actually getting profitability over a period of time, will they have enough cash currently to sustain that journey? So those are the basic shifts which I have seen, at least which the analysts or investors have started asking. And they are just not bothered about what we say, what kind of growth story we have. Obviously that is given now. They are more keen to understand it has to be a sustainable, profitable growth, wherein the shareholders returns are obviously predictable, and they are actually sustainable for a long term basis. That is the critical aspect of the communication now with the investor community.
So, Rastogi, EV manufacturing runs on a very different working capital cycle compared to the traditional automotive. Longer wait times for important components, and then there is a less predictability for the vendor payment, and sourcing that is still evolving locally. What are the changes have you been making to your capital approach to make this work financially?
Say the basic law remains the same irrespective whichever business it is, whether it is EV or something. But tighter integration between what we are going to sell, what we are going to produce, and what is the timeline, and along with the treasury aspect, right? So it should be tightly linked. So we know when we are going to sell the product, understanding what kind of inventory which we need to build to ensure that there are sustainable supply chains, and we do not lose the production days, because that becomes very, very critical. The customer should be fed on time. So obviously, we have been looking at localization. How can you develop the source which is next to your manufacturing facility, or if it is imports, whether we can develop a source which is actually within domestically available. So those are the strategies which at least we have adopted, wherein we have clearly very specific timelines to when we will receive the product, what is the cost of the product, and obviously when can we deliver. So it actually provides some kind of a sustainability and predictability to the overall working capital requirements. How much inventory do I need? How much vendor payments do I need to do it? How much money will I receive it from my customer? And eventually whether I will be able to basically maintain my healthy working capital. So the lowest inventory is not necessarily the optimal inventory now, right? As simple as that. So the objective is the lowest risk adjusted working capital that protects the production continuity, as well as obviously the customer supplies, right? So if you have we have to look at holistically and then take a call whether it makes sense or not, and whatever company has to make it their own judgment to see what their conditions are, what could be the best use of the working capital accordingly.
Yeah, very well explained, sir. So with that, I would like to move for our rapid fire round. So sir, are you ready?
Yes.
Yeah. So my first question is, debt or equity, or your gut is instinct?
Equity for uncertainty, debt for certainty.
Okay. One word that describes your leadership style.
Yeah, empowering.
Okay. Excel or dashboard, which do you trust more?
Well, they have two this thing, but Excel is for analysis. Dashboard is to just operate.
Yeah. The most overrated metrics in finance today.
Adjusted EBITDA. It does not has a cash flow there, so yeah.
One skill every young CFO must have.
They should understand the business, and they should have definitely very good commercial judgment, right?
IPO or private capital, which excites you more right now?
Well, private capital, when there is uncertainty, and when there is certainty, obviously you go for IPO.
Okay. One book every finance professional should read.
So I would suggest The Outsiders by William Thorndike.
Okay. Long-term vision or quarterly results?
Say you have to deliver long-term vision through quarterly results. They are all together.
So cash reserves or in reinvest everything?
You have to still get to a sustainability level, and obviously you have to work for cash invest, provided you can sustain your volatility in this thing. So you always should have that money to sustain in the volatile market.
And the last one word to describe India's EV story in 2026.
Oh, it is at an inflection point right now. So
yeah. At the end of this conversation, is there anything that we have missed from our side and you might like to address?
I think you covered it well, actually, and the only closing point I will make is that currently the businesses are not yes and no, right? You have to go through, and the CFOs should learn how to manage the volatility, which is far more higher compared to what anybody would have seen in their lifetimes. That's it. And they should prepare the business accordingly.
Well, with this, I would like to conclude the session. Thank you, Mr. Rastogi, for joining us and having such a candid conversation with us.
Thank you so much. Thank you so much.
Thank you, sir.